There's one number that quietly tells you how the entire metals market feels, and this week it dropped to about 61. It's called the gold to silver ratio, and right now it's flashing a signal that long-term investors pay close attention to. As of mid-June 2026, gold is trading near $4,360 an ounce. Silver, meanwhile, has climbed to roughly $70 an ounce, a level it almost never sees. Divide one by the other, and you get the gold to silver ratio, which sits at about 61 today. In plain terms, it now takes about 61 ounces of silver to buy a single ounce of gold. When that number is high, silver is cheap compared to gold, and when it's low, silver is relatively expensive. For most of the last decade, this ratio lived up in the 80s and even spiked above 100 during the 2020 panic. So a reading near 61 means silver has been outrunning gold, quietly closing the gap. Why does that matter? Because silver is both a precious metal and an industrial one, used in solar panels, electronics, and electric vehicles. When the ratio falls like this, it often reflects rising industrial demand and growing doubt about the long-term strength of the dollar. It's also why silver miners can swing far harder than the metal itself, rising and falling with leverage to silver's price. None of this is a forecast, and none of it is investment advice. It's simply a way to read what the market is saying. So the takeaway is simple. The gold to silver ratio is a thermometer, and at 61, it's running warm towards silver. If this made the metals market a little clearer, subscribe so you don't miss the next one, where we break down what silver miners actually are and why they move so violently.